make 200%, 300%, even 500% returns on your money? Sound too good to be true? In this educational episode, I'm going to talk about how to utilize the banking concept, a laser bank, to generate millions of dollars. Get ready. This is going to blow you away. So this would be maybe the ultimate way of becoming your own banker. Check out some of the other episodes and stay with me to the end because I want to gift you a copy of my most recent best-selling book, The L.A.S.R Fund, if you haven't claimed your free copy yet. So let's make sure you understand where I'm coming from as we proceed, and you'll see how you can make 100% to 300% returns on other people's money, even 500%. A lot of times people will say, well, Doug, I've watched some of your educational videos where you borrow money at a lower interest rate, tax deductible, and then you put that money to work in a L.A.S.R fund and earn a higher rate compounding tax-free. Yeah, that's called arbitrage or spread. It's really what makes the world go round. This is how banks, credit unions, and insurance companies create mega wealth, okay? They pay interest to make more interest. Their greatest assets are their liabilities, is what I teach. Well, people say, well, how did you fare in 2008 during the Great Recession? And I love people to ask that question because they think that it backfired on me. No. It backfired on the people who did not take the time to understand this. So let's make sure you remember what the economic climate was like in 2008. Banks in 2008, for every $1 million of money that we deposited in banks in a lended position, okay, they were paying less than 1%. Let's give them the benefit, 1%. So on $1 million that people deposit in the bank, they're going to pay $10,000 a year in interest on that. Now, if you remember what happened in 2008, 400 banks went under. 900 more were on the watch list, on the brink of going under. And a lot of Americans don't realize how close we came to a total financial collapse in 2008. And that's why David Walker, the Comptroller General for the General Accountability Office, resigned because Obama just came in and didn't want him to alarm Americans, keep them in the dark. And he didn't like that. And he is a big proponent of what I'm talking about here. And he says the best place for liquidity, safety, rate of return is the max funded insurance contracts. He understands the Internal Revenue Code really well. Okay. And so during that period, banks were in trouble. And so the federal government asked the 5 major banks in America to disclose where they had their tier 1 assets for liquidity and safety. And they revealed that 30 to 40% of their tier 1 assets was invested in insurance companies. Legal reserve insurance companies who have weathered the Great Depression with flying colors. I mean, in the Great Depression, banks closed. 40% never reopened again. Not one single legal reserve insurance company went under in the Great Depression. Well, the same thing happened in 2008. There was a couple of insurance companies that had a lot of mortgages they couldn't call due or anything like that. So they had temporary, cash flow issues. And so they used TARP money just for a few months, like American General. But I had a client who died 3 weeks after they were declared temporarily insolvent, and it was a $2 million death benefit. They paid out that $2 million death benefit in 3 weeks just like that. Where did they get the money if they were insolvent? If you don't understand the multi-trillion-dollar legal reserve insurance industry, all insurance companies cross-insure each other so that if one is temporarily insolvent, all the others have to ante up. It is way better than FDIC. And so that's why we want to put money into institutions that are liquid, safe, and earn predictable rate of returns greater than what we're having to pay for those funds. So banks know this. They turn around and they said, we put 30 to 40% of our Tier 1 assets in insurance companies. And they just settled for the general account portfolio rate, which was actually 5% back then. Let's just say 4, okay? So 4%. So they're making $40,000 a year. The very first year. They only paid $10,000. So yeah, it's a $30,000 profit, but when you talk about it, it's 400%. Would you hire an employee for 10 grand that made you an extra 40? Would you buy a widget machine for 10 grand that made you an extra 40 grand? See, that's called a 400% return on equipment cost or employment cost if you're a business owner. Well, people say, well, Doug, what were you doing in 2008? Well, interest rates are relative. They were low for me. I was borrowing money, let's say $1 million at 3 3/4%. tax deductible. In a 33% bracket, that's a net cost of 2.5. So on every million, I was paying out of my pocket 25 grand, but I was making 10% by diversifying in my laser funds. And so 10% was 100 grand. How much more is 100 grand than 25 grand? It's 4 times. It's 400%. Basically, what I'm saying is the banks were making 400%. I was making 400%. We were both happy. How about you? Now, there were critics who, in 2008, when they saw real estate go down in value, they thought that my strategies would have killed me. They didn't understand, okay? In December of 2007, I could see the writing on the wall. I went out and refinanced my house that appraised for $1.5 million at 100% loan to value, 80% loan to value on a first mortgage. And then I always take out a second and third mortgage up to 100% loan to value. So I separated $1.5 million on the first mortgage at 4.5% interest, tax deductible. That's a net cost of 3 on $1.5 million. That's 45 grand. On that $1.5 million, I'm averaging 8 to 10. Let's just say 8. 8% is 120. Would you hire an employee for 45 grand that made you an extra 120? You bet. That's a $75,000 profit. That's what I was doing. Now, by the end of 2008, a lot of real estate in America had plummeted. And people said, oh, neener, Mr. Andrew, you're underwater. Yeah, my house went down in value to $1.1 million. Did I care? I didn't lose 400 grand. If I would have left that money in a big down payment in the property, I would have lost 400,000 for sure. I didn't lose it. It was safely tucked over here, okay, in my L.A.S.R fund. So let's just break out that 400 grand. If I was paying 6% interest tax deductible on that 400,000, that's 24,000 a year gross, but it's a net cost of 4%. It's only costing me 16. If that 400,000 is earning just 8%, that's 32. I can take half of the interest I'm earning on that 400 grand and meet the mortgage payment. See, the mortgage company loved me. They didn't have to worry about me. I had liquidity, I had safety, I had a rate of return double the cost of the mortgage. People who did not understand this and had all of their money tied up in a down payment or extra principal payments, they lacked liquidity. They lost their homes in foreclosure. Sometimes people have to go through a bad experience to learn and really understand this concept of how to become your own banker. So I helped a gentleman when he came to me at age 70 and a half. His wife had just passed away. And this gentleman had $600,000 in his IRAs and 401ks invested in the market. That $600,000 is what his balance was in the year 2000. From 2000 to 2012, he saw that $600,000 balance go down to under 360 twice. And it was barely back to 600 grand. That's why we call it the lost decade or the Great Recession. And his advisor, at the end of 12 years of a 0% growth, said, hang in there. Now, leave your money in the market and take out 4%, the 4% rule that I talk about on this channel, which is pathetic in my opinion. What's 4% on 600,000? That is 24 grand. That is approaching the RMD, required minimum distribution. I said, oh my heavens. He pulls out 24,000 and he's in a 33% bracket. He pays 8,000 in tax. He's netting 16,000 to buy gas, groceries, prescriptions, and golf green fees. That's pathetic. We rolled out 150 grand a year for 5 years because he was able to earn an 8.25% average rate of return. So at the end of 5 years, the 600,000 actually had grown to 750. Now, worst case scenario, we pull out 750,000, 150 grand a year. We pay a third in tax, 50 grand a year. So we pull out 750, we pay tax of $250,000, we net 500. 500,000 in a L.A.S.R fund at 8 to 10% will generate 40,000 to 50,000 a year of tax-free income. How much more is that than 16,000 after-tax IRAs? Yeah, it's 3 times more, but no, this is what we did. This gentleman came to the same seminar and he went, oh my heck, I'm a landlord. I own multiple properties, non-owner occupied rental income properties, duplexes. He said, I've been taking the positive cash flow, the rental income, and plowing it against the mortgage, thinking that's the smartest way to pay him off, until I showed him different. So he went out immediately and refinanced 4 of these duplexes because he had been killing his partner, Uncle Sam, paying down the mortgages. He took out $1 million mortgage on each of 4 properties at 4.5% interest, tax deductible, and a 33% bracket, a net cost of 3. So he began to now pay $30,000 in interest a year on each of those. But on that $1 million that he put into laser funds on each of those 4 properties, he was earning 9, 300% more. He said, Doug, I am making so much money, I don't know what to do with it all. So we set up a charitable fund and everything like that. A family bank is what we call it. But what was the strategic byproduct that came along for the ride? With 4 new mortgages at $1 million each and writing off $45,000 on each, that offset 100% the $150,000 of IRA 401k rollout every year for 5 years. We got $750,000 out totally tax-free of his IRAs and 401ks. So he actually ended up netting in his laser fund, not $500,000, but $750,000, earning, 8 to 10%. That's generating $60,000 to $75,000 a year of tax-free income versus his advisor that said, hang in there, take RMDs and enjoy the $16,000 after tax. Do you see the difference? We do this all the time. So let me blow you away with one last concept. If I have $1 million of cash value in my laser fund and I need to access that for business, I use this as working capital. And so I can go withdraw $1 million. That's not smart because now it's not in there earning interest. So the smart way is to go to the insurance company and they will loan me. I don't have to qualify. They'll loan me the equivalent of the cash that's in there or the interest I'm earning. No brainer. So they'll loan it to me one of 2 ways. One is a zero wash loan. They'll loan me the money at 2% because they have to charge a minimum statutory interest rate to qualify. So it's tax free. So they charge me 2%, but then they credit me 2% on the $1 million that stayed there collateralizing the loan. So it's a net cost of 0. Okay. I rarely use that. Most of my savvy clients, they use the index loan like I do. And so I can use an index loan and it's a higher rate. People say, well, why would you borrow your own money at 5% when you can get it for nothing or 2%? Because they're going to keep crediting me on that $1 million of collateral, the indexed rate. And I've been averaging 10. How much more is 10 than 5? 100% more. Why would I give up 100% rates of return by withdrawing my money? I do it the smart way and I earn 100% more than the cost of the funds. Well, how does that play out in real life? I'll show you. I have a savvy client who is a real estate investor, but he doesn't like to be the landlord. He usually buys up strip malls or big apartment complexes, fixes them up and flips them to a pool of investors. And so, but he doesn't like to hold on to them. And in 2017, he called me up and said, Doug, I need $1 million out of my laser fund to tie up a piece of property with $1 million of earnest money. He said, send me over the form. He's done this before. He gets this 1-page form and he puts his name and his policy number at the top and it says, you want to withdraw $1 million? No. I want to borrow. Does he do the zero wash loan? No. I want to use the index loan. So what he did in 2017, he borrowed $1 million from the insurance company that fast, okay? And they charged him in 2017 5% on the index loan. That's 5% on $1 million. Does he have to write out a check for $50,000 at the end of the year? He can. He didn't have to. It's automatically deducted from his balance in there. But here's what happened in 2017. The $1 million that he left there as collateral for the loan got credited 25%. He capped out that year, the highest cap. And he got $250,000 credited. You take the $250,000 minus the $50,000. He netted 20% or $200,000 tax-free on his $1 million while he was simultaneously using that money to make $2 or $3 million buying and flipping a piece of real estate. Is this blowing you away? I hope so. But if you don't understand how to become your own banker, you're going to miss out, okay? So here's what I would recommend. Start by studying my book, The Laser Fund. Now, this is 300 pages of information, charts, graphs, and explanations. If you're a right brain learner, you flip it over and there's 62 actual client stories like this one, okay? You can use your right brain and left brain. Use your whole brain, okay? But this is not about me. This is about you and your brighter future. So if you'd like to read and learn, click on the link below, laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost and I'll pay for the book. If you buy one on Amazon for $20 plus shipping, thank you, but I'll gift it to you free. Now, while you're in there claiming your free copy, if you like to listen and learn or watch and learn, check out the audio and video formats that are available. There's even a masterclass in there, which I would highly recommend. But also check out some of the educational webinars we teach on a regular basis. They're free, but you can also schedule an appointment right there online for a quick consultation with one of the creme de la creme top IUL professionals that are certified to see how these strategies can apply in your particular set of circumstances, because you want to make sure your laser fund is set up correctly. And unfortunately, 99.9% of IULs in America are not structured to do what I've been talking about here. I want you to be able to have the potential of earning 11 and netting 10 instead of being lucky to earn 6 and net 2, okay? And that's what happens with so many people, because the agent who set up the IUL didn't know what they were doing, okay? So it all begins with claiming your free copy. Go to laserfund.com and I'll see you on the other side of your brighter future.